Oh, that's different. They changed it.
What did they change? We're live now, aren't we? Huh?
They don't do like the poof and then live thing. It just said live. It's like, oh, I got a little red button up here.
There you go.
Hello, everyone. It has been some time. Welcome back to the Orlando Real Estate Buzz. Brendan with Next Home Neighborhood Realty, and joined by Joe from Aptly Home Loans. Good to see you.
What's up? Yeah. There was a little break, but there was craziness every which way. I felt like the last couple months. It was wild.
We both had things pulling us this way, pulling us that way. A lot of good learning opportunities. I've learned a lot. New markets opening up for us that we're still working on. Hopefully we'll be able to shed some light on that maybe in about 2 weeks. Goes to a lot of the stuff that we've just looked at over time. So we're going to give you back to our Thursday schedule, and just trying to keep everybody up to date on what's going on in the market. No BS, no fluff, no salesy. The world is wonderful. It's all sunshine and rainbows.
I mean, if it is, you'll know. We'll tell you that. But if it's not, we're not gonna lie.
No.
Because I think the fact is we gotta be honest with where the markets are and what's going on, because that's gonna dictate strategies.
Yeah, it was interesting. I was in a group early this morning, and we were talking about things, and one of the things brought up is a lot of realtors, mortgage brokers getting on there, and it's a wonderful time to do this, it's a wonderful time to do that. And sometimes it's just like a little dose of reality. You don't have to be pessimistic, the world's going to end tomorrow, but think about things before you open your mouth and stick your foot into it. As Granny used to say, what is it? Better to keep your mouth shut than open it up and, let everyone know that you truly are a fool,
Well, in that case, I'm going to mute myself.
So, I mean, there's a lot with the change going on, with the new administration.
Yeah.
I think it's really left a lot of people wondering what's going to go on. Biggest question I think I got was, when's Trump going to bring down rates? And
it's hard for that not to be a question. He said that's what he was going to do.
I know, but he can't walk over to, well, he can.
He's going to try.
He's going to try. Call up Jerome. Hey, Jerome, how you doing? Life's wonderful. Yeah, you're a wonderful guy. Yeah, you're doing a great job. Yeah, now cut rates.
Yeah, if you want to keep that job, cut rates. No, he's going to be hitting it with the Jerome. You don't want me to say you're fired.
Yep. Because he's got 1 year left, right? On his,
I think so. Yeah,
on his tenure, 1 year. So, but I think the biggest impact that this administration can have is actually with the DOGE program. It's because here's the whole concept, and it's so simple in that when you're borrowing money again and again and again and again, you got to find people who are going to lend you the money. And when your credit's not so good, when you're looking at things, people don't want to lend you at 2% anymore. They're and that's why we saw, even with the rate cuts, Treasury bill spiked, and it all came down to that spending.
Yeah.
So, and I think Elon put it well the other day, is like, we've got to make sure, the America is a big ship, and we got to make sure that ship stays afloat, because if it doesn't stay afloat, we're all going down with this ship. And, it's not going to do us any good if our country goes bankrupt.
Yep.
So there comes a point where, and I've said this for years, is someone has to get up and be the adult in the room and say, no more of this. I mean, I really find it hard to believe there's people out there protesting that we're not going to spend $1 million on condoms for Hamas. And they're upset. And it's just like, okay. And you looked at some of these programs, the list that they were just putting out, and you're just like, come on. I'd love to have some of the money back to do some things with my kids. Not continually burden them with all this debt that's being added on. So, I mean, they've got a target of $1 trillion to cut. $1 trillion.
Which is significant and staggering. And and the hard part is he's doing some very polarizing things, right?
Yeah.
Some of the cuts are very straight parent, and they're finding things that you're like, we were spending money on what? I do think some of the cuts are probably things that, maybe lean into more of maybe how CIA and stuff moves money around.
Yeah.
Just saying. So they might be cutting themselves in certain areas there because they can't straight up say, hey, we're doing X, Y, Z. So maybe that's, but I also think that, they might be making some polarizing cuts that maybe people aren't like, I saw Doge was cutting the survivor fund for 9/11 victims. That's a very polarizing one.
Yeah.
So there's going to be cuts.
Cutting the Social Security for Civil War veterans. I know that's a tough one.
That one was a tough one. That one was one that I'm like, really tough.
Yeah.
I'm very curious who's been cashing some of those checks for those 250-year-olds that were still collecting.
What about the 300? There was, I think, what do you say? There was one who was 364 years old.
Perfect. Didn't look a day over 320.
Yeah, but people, you look at this, and it's like, okay, you got, what was it, 1.5 million people, like 150 years of age. Well, if you've got 1.5 million people, let's just say 1 million of them get Social Security on a monthly basis, $1,200, simple $1,200, right? That's $1.2 billion a month going out the door. So you think about it, there were several brackets. So there could be payments of $6 to $7, $8 billion a month going out the door to people we have no idea who quite honestly, come on, they're dead, and you add that up. Okay. So times 12, that's over $100 billion right there. That's significant. That's significant savings. And that's really what we have to do right now is we have to look at it. We have to cut the deficit. The deficit's got to go away. At some point, we can only spend what we take in. And I mean, looking at the stuff, I could see them being able to cut that $1 trillion, within a year and a half.
And I think that's the key is, like you mentioned, being fiscally responsible, because a lot of what we're feeling as consumers at the end are it's a ripple effect from what's happening on a federal side. Federal spending, the deficit, all of that plays, all this monetary policy, everything plays in. It all starts from up here, and we see the ripple. And the problem is what starts off as a tiny ripple turns into a massive wave by the time it gets down to
because it is making everything more expensive. If your cost of money is higher, you've got to charge more to recoup. If I'm paying, if I'm paying 10% on my money to run my business, and then all of a sudden it jumps to 20%, 20%, of course I'm going to have to increase my price to cover the cost of the money to operate my business. And that's really what it is. It's such a simple concept that I don't understand. I don't understand how people can't grasp it sometimes. And it's just like, okay, but we're also person said something interesting today in that we're no longer a paycheck to paycheck country. We're a credit card to credit card company, our country. And it's like, wow. Then I immediately thought we've got over $1 trillion in credit card debt.
Mm-hmm.
So that's actually a good way to put it, because people are moving balances here to here, here to here, here to here in order to survive.
Yeah, they're kicking the can.
They're kicking the can. I mean, I've got my Costco card through Citi, and credit card is, if you want to, you pay portion, you don't pay the whole thing. But they send me emails on all the groceries that I buy at Costco and give me deferred payments on the credit card payment. And it's like, what? Like, hold on, I got to look at this, And it's like, oh yeah, you can this payment of $125, you can stretch this out here, and it'll be added to your minimum payment balance. And I'm just like, that is weird. That's strange. That's just not right. So that, to me, that's, getting back to the Doge point, is that could be one of the biggest things that helps bring down interest rates is the elimination of all this fraud, all this extra spending that we don't need to have. Because, Elon put it is, hey, if I borrow less, the interest rates are going to go down. And he's right. He's exactly right there. And that's where we can start to see things spurred up in that area. So looking at that, and then I think the other things, looking at in the market, how the market's going, is we're steady.
Yeah. Which market are we talking? Are we talking about my market or your market? Talking about real estate or mortgages?
Real estate.
All right, real estate. Okay.
Real estate's kind of steady. How's your market overall right now?
Yeah, it's well, I think it's very interesting. We saw a little bit of a tick up in February. Everything ebbs and flows. We talk about this all the time about when interest rates go up, everything dries up, and we saw from the election, right? The election cycle, we saw rates go down, but then immediately in December, rates spiked again, or started going back up. And then in January, they started coming, mid-January, they started coming back down. So what's funny is we saw our best rates in the last probably year in December, at the start of December last year, December 5th, 6th, that time frame. We were touching fives again on conventional. It was amazing. High, had to pay a little bit of points, but it was kind of really cool to be like, hey, how's that 5.99 feel? We're like, oh my gosh, it's amazing, right? And I never thought people would react the way they were to it. But we've been so hot. But then immediately we saw it changed. And by, second week of January, we're sitting at 7. And, we're back up to 7.25 on conventional. Now we're seeing it back down to where we're now in that 6.5, that range, 6.625. We're improving. We're seeing kind of rebounded back, which was really good, because I was afraid we were going to retouch on the 10-year T, the 10-year. I thought we were going to touch 4.8 again. We're sitting right about 4.5.
Yep.
But if we go back to December, we were sitting at 4. We touched 4 at one point. That's a big. We're still got a long way to go, and we saw how bad rates got, that quickly. It's going to be, and I think investors are still very hesitant, because I think a lot of them think we're going to touch 4.8 again before we touch 4. So I feel like pricing is kind of lagging more than where I think it should be.
It's going to be interesting, because I haven't seen any numbers on spending yet. Which usually you get those January, February, March. We should see what they spent in the first quarter and what they borrowed in the first quarter. And if we see numbers coming out where we've seen decreased spending on behalf of the federal government, I think that's going to be the initiative that's going to allow us to start seeing the 10-year T starting to drop overall. And if we can have consistent, I think even if they can bring the deficit down before the end of the fiscal year, end of September. If they can bring it down $500 billion, I think that will truly help out rates overall.
Yeah.
Not only help out the economy.
Mm-hmm.
The thing that makes me nervous, and this is what can skew a lot of things, and again, it's all how it's presented in the news, is a lot of people don't realize that our deficit spending gives us about a 2% jump in DD, or 1%, 1.5% jump in gross domestic product. So when we cut that government spending, we've been seeing 3.3, 3.2. Well, you take off the deficit spending, we're actually more like 1.5%.
Mm-hmm.
So all of a sudden you may get news reports that, GDP is only growing at 2% or 2.25% as opposed to 3%. Well, then you got to start getting into the numbers and realize that, hey, by cutting this the deficit spending, we're actually cutting our GDP, but it's a little bit of pain here in the number, but at long term, it's a definite benefit for us. And those are the tricky kind of things you got to watch, because the media can make it look out to be something that's bad, but when you look into it, underneath the numbers, it's like, oh, hey, but they cut $500 billion of deficit spending. We didn't borrow this $500 billion, and it actually helped cut the 10-year treasury and other treasuries from 4.5 to 4. So there's a yin and a yang to everything. So you got to look at the whole scope of everything overall.
Yep.
To really understand what's going on. It's not just look at one number and like, oh my gosh, our gross domestic product's only 1.5%. I'd actually be happy with that, because it'd be an honest number.
Yep.
Not a number that's being inflated by credit cards, debt of the United States government. So
all good stuff there. All good stuff.
But I'll tell you what the biggest question is today. Is the gold still in Fort Knox?
I don't know. It was misplaced.
Well, I don't know if you watched the gold market, but there's been a ton of gold being brought into the U.S.
Really?
Yeah. The Comcast, I forgot what they call it, over in London, ran out of gold a couple times in the past couple weeks. And a lot of it's going to the U.S.
Interesting. Very interesting. Let's see. Any other quick hit items we want to talk about? Let's see. Jobless claims came in. Where do we think? We think we have more or less initial jobless claims from last week?
I did. That's not fair. I didn't get to see the report.
It's a guess. More or less.
I'd say flat.
219 last week's revised numbers were 214. So you were correct. Pretty much flat. A little bit of unexpected. Fully expect that next week's they'll revise back this week's.
Yeah,
because that's
are they starting to take in the numbers from the layoffs in the government?
I don't think any of those are going to be factored yet. Those are all not. Those don't count. They're exempt. Like that's.
You want to have fun? You want to have fun? Go on Zillow. Do a geographic circle around Washington, D.C. right now.
Oh man, yeah, you're probably gonna be right. But yeah, and I think overall we see, I think with a lot of that, I think it's going to be very interesting over the next, probably like you said, 60 days to 90 days when it comes to actions that the Doge is doing, and what's the bigger ripple effect that it's going to have.
Yep.
A lot of them are getting buyouts. They're still going to get paid some, they're still going to make money. So we're not going to feel it initially, but we will see, we will see some of this play into effect. And I think we're going to see it have a ripple on the housing markets. One thing that I saw recently, article that posted, there was talk that people are moving back into large cities at a higher rate than they have, where everybody was flocking away from big cities. Yep. Now people are moving back to big cities. Have you seen any data to kind of play in on this, or theory, or is it kind of more or less just news kind of?
Not, I really haven't seen that. Mainly because of affordability still.
Mhm.
That is still the biggest problem is affordability. I'm going to go show some houses this evening in downtown Orlando area,
Mhm.
1,700 square foot houses starting at $600,000. Where we've got a new construction, 1,700 square feet in DeBerry.
Mhm.
We've just put in a contract down for 350,000. That's about a 12-mile ride. That's it.
Mhm.
So no, I haven't really seen that. What I've seen more of is people looking for the best deals they possibly can and weighing
Mhm.
the difference between, okay, do I want um, a new house with a reasonable mortgage and a 20-minute drive, or do I want to pay $600,000, be stressed,
Yep.
and be 5 minutes from work?
Mm. Yeah.
And people, you've just got to weigh that out.
Mhm.
And we're still got really I think it's about 65% of the market that can't qualify for homes over $300,000.
Mhm.
That is one of the top search um, keywords out there right now is
Yeah.
homes for sale in pick a city under $300,000. That is actually one of your top searches on Google.
Mhm.
So it tells you where everybody's mindset is there's still, people still think they can find a house at that $300,000 level. Are there spots, one or two? Yeah.
Yeah.
Yeah, it's like anything. But you are seeing, I'll give you a perfect example. The home we looked at is at the what do they call it? At the junction in DeBerry. It happens to be a Stanley Martin built home, nice
Mhm.
home, um, small lot, but when you look at the property, and it started out at $395,000, dropped to 376, and they just
Good
dropped
job.
it to 345. So
Okay.
we back
So.
so we and we're still and we're it's a 1031 exchange, so they're you know it's an investment property, but we're still getting $5,000 of cash on top of it.
Mhm.
So and you're seeing that with a lot of the builders right now. They're they're having to actually drop their prices to make things affordable for
Mhm.
people. And at the 345 now, it actually makes a
Kind of
lot
makes
more
sense a little
sense.
bit.
Yeah, than at that $400,000 level.
Yeah.
So the market, I think, overall is gonna it you're seeing corrections. You're seeing the biggest price drops. I pulled all the price decreases in the past
Mhm.
week for Seminole County. Um, of all the price decreases, 42% of those houses have been on the market for over 100 days. That's
Mhm.
a big percentage. And that's where you're seeing the biggest price drop as well. And the price drops per category, under 250, 500 to 750, over $1 million. The places where you're getting the biggest price drops are actually the lowest level, under 250, and the
Mhm.
highest above $1 million. And above $1 million was averaging a 6% price decrease. That's a big price decrease, on a $1 million house. So that's basically six was it $60,000, something like that?
Yeah. Yeah. That's
Average
big.
average price decrease on the house. So I think the market's still got a long way to go. Our average days on market is I believe 72. We have on average about it's 5.33 months of inventory right
Okay.
now. In the 500,000 and above, you're at 7 months. So that's a definite buyer's market. And $1
Mhm.
million and above, you're over 8 months on the market. So it's for a buyer right now, if you can afford it, if you've got that ability, to me, there's a lot of negotiating room. And it's how how do you structure things now to take advantage of these price decreases and these concessions that these sellers are taking.
Yeah.
And quite honestly, my suggestion and what I'm explaining to people is you need to work with your mortgage lender and your realtor together to figure out the best solution. Because right now, I know you and I talk about it with different clients is, okay, if I can get a $10,000 concession, how much can we buy that property? How much will that save them
Mhm.
over the next 30 years? Knowing even over the next 10 years, because these days most people stay in their houses for 10 years. So over 10 years, if we're able to buy the rate down, a 0.5%,
Mhm.
how much is that going to save them you know, over that time period? And is it better to do that than to ask for a price reduction? A lot of times it actually turns out to be better overall to do a rate buy down these days than it is to ask for a price reduction. Well, maybe you
Yep.
get $5,000, $6,000. Does it really make a difference? At a 7% rate? No. But if I take and ask them to buy my rate down, which will still cost me $6,000, say, and I buy down half a rate, my savings over that 10 years is going to be a heck of a lot more than just taking that $5,000 to $6,000 discount off of the price of the home.
Mhm. Okay. Yeah.
So there's a lot of nuances that you're seeing and a lot of nuances that you've got to play with, and you've got to be able to we got to be able to look at all the scenarios for our clients these days.
Mhm.
And okay, if we do it this way, this is what it's going to cost you long term. If we do it this way, this is what will cost you long term. Oh, and we can look at this option as well. Um, One thing in Orlando that I'm starting to think of how to present, and I've talked to a couple clients about this, is I had a listing, um, a management listing for a national management company over in Castleberry, right by you, not far from you, about a mile from where you live, and it was
Mhm.
listed at 3250. Nice house with a pool. I had 27 people apply for that house for the rental.
Wow.
27. And I mean, I was actually shocked. I figured it would go pretty quick, neighborhood,
Mhm.
school district, all that kind of stuff. But 27, and that kind of tells me that there's still a need for rental properties, good
Mhm.
quality rental properties. So all these people who are locked in currently at these, 2.5%, 3%, 4% mortgages, if you're looking to move, you may want to really consider renting that property and then buying your new house and looking at those numbers overall, because
Mhm.
normally your mortgage should be less. You're allowed what, 70% of the rental payment, so it should cover that.
Yeah. 75%. Yep.
Yeah. So to me, it's a new strategy to start looking at different ways to get, because there's a lot of people who are locked in who are thinking, what do I do? How can I do this? You know,
Mhm.
so it might be a way to look at things that we haven't really kind of looked at in the past. Maybe you do a HELOC, take some of the equity out, and still run your numbers to
Yeah.
see, hey, okay, if I take 100,000 out to put down on my new house, and now between my HELOC and my first mortgage payment, say I'm at $2,500, but I can rent it for 3,500. Oh, I can get out of my house. I can get into that new house that I've been waiting for.
Yep.
That people haven't had a chance, to look at that. So it's something. It's another way to look at it, and just, it's not like anything. Run the numbers, see what you can find out, see if it makes sense. If it makes sense, great. If it doesn't, hey, at least you know where your numbers are overall, so that something changes down the road, you can adjust. You can make some changes.
Yeah. So, I mean, really, really good strategies. And I know we're kind of running a little bit short of time. We're actually almost out. Like, really, probably should be ending. But there's one other thing that I want to talk about, and I want to mention is, have you heard the discussions about HJR 357 in Florida? House joint 357.
Is that getting rid of the property taxes?
No.
Oh,
but it's something that has been that has made it into kind of that potential amendment to the state constitution in Florida. Has been talked about in prior sessions. This one's actually getting some teeth. Is taking a homestead exemption and increasing it from 50,000 to 100,000.
Ooh!
So this one is actually in right now, because Florida is like, we're in session right now. If something's going to happen, we're in session right now. Florida Senate, all that. This is when stuff changes. State laws, all this stuff happens in Florida. But this one's actually getting some traction right now. And it would be a big one. We talk about affordability, and this is one of those areas where the state is saying, hey, wait a minute, we might need to look at ways to create extra affordability. Part of that is the property tax bill. Currently, this bill is in Ways and Means Committee. It's so it's basically that's the what does it really cost committee. Like that's the one that's kind of looking. Hey, is this legal? Does it are we breaking the Constitution? Are we doing anything? And what's the implication in the cost? Obviously, the cost is pretty significant because it's doubling whatever homestead. So there's a cost, right? Is there a cost to the state? Yes and no. To implement it, not really. But they're losing tax revenue to the counties, right?
Yep.
But I think it's something that's really important because it wouldn't go into effect until 2027 if it does pass. So I don't know why they couldn't make it go into effect next year. They got to give themselves a buffer for a little extra tax. But I thought it was really interesting to see the state take it seriously, see it proposed, see it actually get some teeth. I'm hearing some positive news about it. So hopefully within a couple of weeks, we may actually have a really good update for everybody about this. On average, that 50,000 exemption is about $600 to $700 in tax bill. But the more and that's what it is. And like homestead exemptions, the bigger value is the fact that it caps you at a 3% increase over time, because the people that forgot to file homestead exemption last year or the year before are really feeling it the last couple of years because their tax bill flew out the roof. But if you were to take it and increase it to 100,000, we'd effectively, you, me, anybody else that currently has homestead exemption would see, about a $700 savings, $650 to $700 savings on their property taxes for the next year. It's not a big deal, right? But $50 a month is $50 a month.
Well, especially for a lot of the older people on fixed incomes. A lot of them, between the tax increases and the insurance cost increases, they're finding it very difficult to continue to stay in their houses. A lot of these people, it's amazing actually how many people own their houses outright.
Yeah.
They own their houses outright, but then between their tax bill and their insurance bill, I know.
I talked to my parents. My parents are retired, fixed income. They're Social Security. My dad gets, he's a veteran. He's got a little bit of VA disability. But they're sitting there going, they owe very little on their home. They paid off, they got themselves in position, paid off a bunch of debt. They've got one car that is I think they're 2 or 3 months from paying it off. But now they're sitting there going, our vehicles are older. We've got this, we've got that. And they've reduced and they've seen their insurance go up, more than double over the last 3 years.
Yep.
And then they see, their taxes are helped, but they're sitting there going, the insurance is the part that they're like, we're on a fixed, our fixed income hasn't changed, but our insurance keeps climbing at such a fast rate that it's hard to budget. Yeah. Because, our property, we went from, I think they went from $1,100 insurance policy 3-4 years ago. They have a roof that's only 5 years old and their policy is $2,800 now with no claims.
Yeah.
Like,
Yeah, and it's one of those things that everyone's got to look at when they're budgeting overall, and you don't see any solution in the insurance for
mm,
Florida right now that's going to help at least stabilize the cost. I, I, I know it's probably never going to go down, but at least stabilize it so you're not getting a 15-20% increase every year.
exactly.
Find a way to stabilize this thing.
Yep, and that'd be huge. So,
Yep.
well, that's all I've got for you guys. I'm
Yep.
sure,
No,
great
it was
connecting,
nice.
Brendan. Great to get back. We're going to be coming every single week again. We're getting
Yep.
back into the rhythm. We got to work that muscle again, and make sure we stay on task. Change of time. I don't know. Are we streaming this live right now, or are we posting this later?
No, we're streaming live.
So, little bit different time before. I know we used to do early in the morning.
Yep.
Part of this decision, though, was there's a lot of reports that come out Thursday mornings that can have an impact on the market and on rates. So we wanted to make sure that, today was a relatively quiet day on rates and stuff, but we wanted to make sure that we weren't missing that data to share with you guys if we're going to do it once a week, because really Wednesdays and Thursdays are the meat and potato days for financial reports or federal, like kind of, your jobless, your unemployment, so we wanted to make sure we staggered this so we can actually talk about it.
Yep, exactly. Thanks, Joe. It's great to see you again. And I think every once in a while we need to do the in-person one where we're not.
All right.
I can drive across town.
It is at 2:00. Can we just do? Can we just go somewhere and do it live, from a location with beer? It will really get some hot takes.
Oh my gosh, that'd be hilarious. So, all right, man. Have a wonderful day to all of you. Thank you so much. Please like, subscribe, and join us every week on the Orlando Real Estate Buzz. Take care. Bye-bye.